Hi, and welcome to our panel on adjusting to new dynamics in counterparty credit risk management. I'm Kevin Cook. I am one of the founders and the CEO of Treasury Spring, a London-based financial technology company that my partners and I set up in 2016 with the aim of providing all firms with access to the same cash management investments and financing options as the largest, most sophisticated treasury teams in the world. We do that through the world's first and only fixed-term fund platform, offering our clients exposure to sovereign, SSA, repo or bank secured, and corporate fixed-term funds across all major currencies through a single digital platform. Personally, I have a keen interest in credit risk. I first came across it nearly 20 years ago as a lawyer, dealing with it in a somewhat theoretical sense, looking at drafting covenants and default provisions. That theory very much turned into practice and reality, and somewhat of a painful reality, working in a hedge fund from 2006 to 2010, where my partners and I painfully experienced firsthand the destruction that can be caused when credit risk, as well as some of the attendant risks like liquidity risk and correlation, are mispriced. And really, we've spent the last decade helping organizations of all shapes and sizes to mitigate credit risk from a cash investing, funding, and working capital perspective, and now do that through our fixed-term fund platform at Treasury Spring. Anyway, that's enough about me and Treasury Spring. The focus of this panel is very much to deliver value to our audience by providing the views of market practitioners. So in that vein, I've got the pleasure of introducing three experts in their field. We've got Katherine Horrell, the Group Treasurer of the AA, Marion Barré, the Senior Treasury Officer from the UN Migration Agency, and our very own Henry Adams, the Chief Product Officer at Treasury Spring. Can I ask you each to provide a little background on yourselves for the audience, please? Maybe starting with Katherine.
Sure. So my name's Katherine Horrell. I'm Group Treasurer at the AA, where I've been for 6 months now. Before that, I was Group Treasurer with Centrica for 10 years, and then with Ariva PLC as well.
Thanks, Katherine. And same from you, please, Marion.
Yeah, so I'm Marion Barré. I'm the Senior Treasurer at the UN Migration Agency. And I was preparing some notes for the presentation, and I realized that I was graduated in 2008. So I'm not sure that it was a good sign to continue a career in Treasury, but 12 years after, I'm still here. I started working at Sanofi as a cash analyst back office for 2 years. And then I joined L'Occitane International in Geneva, where I started as a cash analyst and evolved to international treasurer, risk specialist. And now 3 years ago, I had the opportunity to join IOM, so the International Organization for Migration, where I'm responsible for the investment portfolio and the risk mitigation strategies and policies.
Thank you, Marion. And last but not least, over to Henry.
Yeah, thanks, Kevin. Henry Adams, Chief Product Officer at Treasury Spring. My background is very much in financial markets, in the bowels of what goes on. So secured financing in particular, both on buy and sell side institutions, starting at Barclays Global Investors and then moving over to trading at the Royal Bank of Canada in their capital markets division, extending credit to predominantly other financial institutions across the full spectrum of credit. And really the role was to maximize profit per credit risk taken, really. And do so by mitigating all of those risks and providing something that's very clean and clear and manageable from a risk perspective. So my role here is to originate assets that are going to be attractive on a risk-adjusted basis to our client base. And my joining today is not to be with my Treasury Spring hat, but rather to talk around what's happening in markets right now and provide that sort of background and commentary in terms of what the market perceives.
Thanks, everyone. By my quick calculations, that probably means that we've got roughly 70 years of experience looking at credit amongst around the table, which probably isn't a fact that we want to be reminded of, but at least hopefully gives some context to the fact that there are some really interesting experiences, I'm sure, that people can share in the panel. So maybe if we start by thinking a bit about the ways in which counterparty risk affects corporate treasury. And from my perspective, I guess there are explicit risks, the ones that people take when placing cash. There are implicit risks, the ones that people take when putting in deferred payment terms or supply chain. And then there are sort of what I'll call latent risks, which are the risks that people take to any portion of their business that they outsource that's material to a third-party provider, a technology provider, or an intermediary. And so I think it's interesting to just understand everybody's different experiences, particularly focused on the treasurers, as to how counterparty risk really affects corporate treasury and the differing aspects of that you've seen over the course of your career. So maybe again, Katherine, if we could start with you.
Sure. So I go back to 2008 was sort of quite an important year in my career as well, Marion. It was a great time to get into treasury, I think. But I just joined Centrica as assistant group treasurer at the time, and being in the energy industry and having a big amount of energy procurement to do, there was a lot of thinking about credit risk in terms of how that operated in the energy markets that was quite fundamental to the business at the time. And that involved thinking about the credit risk of counterparties as well as your own credit risk, and therefore what that meant for liquidity risk and how you supported contracts, or how you asked your counterparties to support contracts in terms of credit risk. And at the time, as an example, we were energy trading with Lehman Brothers quite significantly, and in the run up to what happened there, actually the business credit team had put in a CSA with Lehman, so we're largely collateralized when that particular crisis happened. But then, specifically in the treasury, it also translated into what we did with our cash deposits and how we dealt with those. And we raised a lot of money in 2008 to fund an acquisition that didn't actually happen until late 2009. So we had a big amount of cash to handle just at the time where banks were being downgraded across the board, and there was a lot of uncertainty about where to place deposits. And then thinking about the derivatives transactions within treasury as well. So lots to manage, and have kind of taken that through into the other companies I've worked at. Now with the AA, which is a very highly leveraged company, spending a lot of time thinking about the AA's own credit risk and the impact that has in both the treasury and the business operations.
Thanks, Katherine. Super interesting. So, Marion, I guess one of the benefits of being at IOM is that you probably don't have to worry too much about your own credit risk.
Exactly.
But you do definitely have other credit risks that you look at. Could you talk a little bit about those, please?
Yeah, just maybe 2 facts about IOM to well understand in which context we are operating. Is IOM is entirely pre-funded. So we don't have debt. So indeed, we don't have to worry too much about our own credit risk and the impact on our financing. And we are what we call projectized. That means that we are completely pre-funded. Every project is funded before to start. So the direct consequences of that is that we are having a huge amount of cash to manage on daily basis, and we have a lot of investment. So obviously, one of our key risk is with our counterparty and the different area where we invested in. And the second fact about IOM is that we are highly decentralized and we are operating worldwide. We have a very large footprint with presence in almost all the countries in the world. So for us, like the counterparty risk of our bank is a very key in our daily operation, because we're working with more than 200 banks. So the risk of default of the banks is a key element that we have to follow carefully, because it can impact our daily operation.
Thanks, and I think hopefully maybe we'll come back to some of those aspects on the emerging market nature of your operating banks a bit later, because I think it's really interesting. Just before we do, to bring in Henry, I know that you were also in a position where you were trading with Lehman and others through 2008, but with a different hat on. Could you just explain a bit about the context to the seat that you were in at that point in time, and how you thought about counterparty credit then, and maybe how some of that played out through 2008 and the financial crisis?
Yeah, sure, absolutely. So the thing about trading repo and the thing about extending credit to the size you would in an investment bank of the size that I was in is that the way you do so, you almost turn things on its head to a degree. So you assume actually with repo that the counterparty is going to default, and then you stress scenarios and you work with credit teams, credit limits are put in place, and then with operations to make sure that those views are correctly reflected, to say that, okay, if this counterparty were to default, how quickly do we get all of our cash back? And in the instance of Lehman, I was still fairly young on the desk at that time, in my mid-20s, but we were extending a large amount of credit to Lehman and other names. And certainly we lost counterparties along the way. And so by having that background of always assuming actually the worst and planning for the best, but having those teams around us as well, in order to make sure that our view was correctly reflected, we did indeed come out whole and sometimes marginally better as well. And so it's a very different mentality, of course, in many ways, because what you are looking to do in investment banking on a trading floor is to ensure that you are generating profit. That is your product. And so, yeah, a very different way to look at things. But I guess, look, the advantage of being in that environment is having all of that infrastructure in place, all of those credit functions globally that I would leverage off there at your disposal in order to take risk, but in a manner, knowing that there is risk out there, but in a manner that you are fully managing that.
Yeah, I think it's really interesting looking at it and comparing that sort of trading context, and maybe going back to you, Katherine, and talking about the way that you were looking at things in the energy sector, where energy firms, to some extent, as you said, there is an element of counterparty credit and trading and what have you that goes on, and the fact that you looked at collateralizing your exposure to Lehman under CSA. I guess, what are the lessons that you learned from that? And then how does that translate into the way that you either looked at cash investing at Centrica, or you would look at it in the role of another cash long firm that you were at in terms of investing that cash?
Yeah, I mean, lots of really interesting issues in. So, if you go back to that period in 2008, clearly, as lots of counterparties were suffering and credit positions were becoming compromised, the instinct is to sign collateral agreements and start posting cash and receiving cash against the contracts. But of course, that immediately affects your liquidity risk. And the other thing that happened in 2008, either as well as the financial crisis or as part of the financial crisis, there was a huge drop in energy prices, and Centrica, as a big procurement, a procurer of energy to supply all its customers, went from having very in the money positions to very out of the money positions. So all of those collateralized contracts saw sort of cash disappearing out of the door to support those contracts. And although it will, that your business has been well executed and that you're just hedging positions that you have selling to customers, you still have this short-term liquidity risk that can be really quite substantial. And I think over that period, the company did a lot in in coming up with better ways of managing its liquidity exposures and evaluating the potential impact that might happen with big movements in energy prices. And actually, during that period, the company had to make some quite tough decisions about the amount of new business it was willing to sign up, based on, what were the levels of counterparty risk it was willing to take, what were the levels of liquidity risk it was willing to put against the contracts it was signing. So, so quite big and fundamental business decisions, really attached to what was going on in the markets and how to manage those risks best for the whole company.
Yeah, I think it's really interesting that you connect the risks there, because when you can't look at credit risk in isolation, and often, as I partially mentioned in my introduction, with credit risk comes other risks that you have to consider. So liquidity risk being a key one from both sides of the equation. So if you're from Centrica's perspective, you might be you've got that two-way CSA, so you're protected from a credit perspective. But as you say, if that means that you then need to post a load of cash, that's going to leave you short of liquidity. On the other side of that, Henry, you probably saw from a bank perspective through 2008 and in other situations, what happens when you get those margin calls and liquidity moves from the system, and liquidity can move quite quickly into being a credit issue.
Yes, yeah, absolutely. And the other thing, of course, to factor in is not just, whilst margin calls are changing, actually underlying asset values. So, a default occurs, administrators come in, and then, of course, it's public knowledge. The market reacts, and the market reacts within seconds. And so where you find yourself is with a basket of collateral that then needs to be liquidated in a market that in certain asset classes is definitely not your friend. And so, the red that you see across stock markets, and you think, okay, there's been a bad day, down 2.5%. These numbers were hugely elevated, multiples of that. And then you're looking to liquidate portfolios of, substantial size in such markets. And so, really then it's liquidity of the underlying asset. It's how much liquidity is there at that price point, and how deep is your position within that. And of course, then it really comes down to ensuring that you understand your own margins and that you are diversified as well with regard to the sorts of assets you might take. And look, sometimes the market can also be your friend with some of the portfolios, of course, and within those embedded, we had a flight to quality where those assets that were deemed as cash-like and risk-free rallied significantly. So it's kind of many moving factors, many things to consider, not a lot of time to do so.
Yeah, one of the keywords that you mentioned there, I think, is diversification, and of course that applies whether you're cash investing or whether you are building a collateral basket for repo, or indeed looking at funding sources. I know, Marion, even in your cash investing activities, you have thought a lot about diversification. Would you mind just telling us a little bit of the way that you approach the cash investment pools that you have and the sorts of assets that you invest in?
Yes, well, indeed, for us, diversification is really key in terms of counterparty risk management, because as treasurer, it's not so easy to assess the counterparty risk. It's like a very complex risk to measure, and we are just using rating and other measure available on the market. We are not credit specialists. So for us, we are reaching the limit of what we can do in terms of measurement of the counterparty risk and to see it happen. So in order to mitigate it, we are doing a lot in diversification. We are really thinking that the diversification is the best way to mitigate that risk. So when I joined IOM 3 years ago, our investment were mainly done in the banking sector. So we were 100% exposed to banks. So the first action that we took with Malcolm Grant, the Chief of Treasury, was to start to diversify from the banking sector and find other class of assets in which to invest. So now we are trying to get away from bank and start investment in corporate bonds. So this is one of the aspects of our diversification. And we are also investing via Treasury Springs to supranational government and to repo investment. So this diversification for us helps to mitigate our counterparty risk and reduce our expected loss in case of default, obviously.
Yeah, really interesting. And Katherine, I know that back in your Centrica days, you would go as far as looking at the details of the different exposures that you might have through your money market funds to the different banks to understand sort of what level of diversification you actually had across your portfolio. One of the things that Marion mentioned there was tools at a treasurer's disposal for assessing counterparty credit. Have you seen improvements or changes in the way that treasurers, in your experience, look at counterparty credit from sort of back when you started, all the way before the financial crisis through to today? And if so, any tips or tools that you'd point to people as things that you found helpful in your career?
Yeah, it's lots of interesting issues. I mean, I remember when I started in Treasury, which was quite a lot earlier than Marion. The methods we had to just evaluate the levels of counterparty exposure were really primitive, and at the time, we'd look at a report and say, okay, so here are some numbers on the page. What do we make of these? They're quite big numbers. How do we feel about it? And just said, well, we're exposed to banks, and banks don't go bust, and then we put it aside and went on to something else. And I mean, it just seems crazy now that you could think like that. And and I think one of the things I had to deal with in Centrica in 2008 was a cross currency swap that was 30 years in duration and had no breaks in it. And the company was really proud of putting in a 30-year swap with no breaks in it. It was a really great reflection on our own credit risk and the bank's willingness to take that position. But we found ourselves very heavily in the money. And the exposure was with a bank that had been downgraded sort of 2 or 3 times in 6 months. And with very limited options about what to do about that, particularly because when we were looking at prices for closing down the swap, you have to take into account the bank's funding cost, and calculating the closeout value is turns out not to be that close to to the mid-market and the level of cover that you think you've got on the underlying. So some really quite complex things in there. And listening to Marion talking about moving into corporate bonds is it's quite a big step in terms of evaluating the risk and understanding the exposure that you're taking, versus bank deposits. And then, as Henry was talking about, repos and how you evaluate the collateral that you take on those. So I think treasurers with significant amounts of cash are having to do much more sophisticated analysis on the risks they're taking. And actually, I think quite a lot of scenario planning is needed for what happens in the circumstance where you have to claim collateral. What happens in if you're investing in a bond portfolio, is that a hold to maturity, or do you take funds? Or then how do you deal with the interest rate risk in all of those, and the the day-to-day capital movements? There's quite a lot of in-depth kind of analysis that you need to do to really understand your position and your levels of risk in those different features. And yeah, I mean, it's a whole world of difference from when I started in Treasury, and we just put a few numbers on a page and shrugged and moved on.
Yeah, I think it's obviously it's changing, and it's changing relatively rapidly. And I think maybe 2 things will accelerate that change. One is technology and the ability for technology to help treasurers in gaining access, in doing analysis, and in diversifying. And I think the other thing that's changing quite quickly is the market, and what credit risk might look like. So Henry, do you want to spend just a very short period of time talking a little bit about some of the credit risk tools that we use now and why they're helpful? And then maybe after that, we can bring up a couple of slides and you can talk about how you look at credit today from a market's perspective and how you think about that.
Yeah, sure, absolutely, love to. So, some of the key things that you want to be looking at and that we would analyze on a daily basis and monitor very actively with those that we do business with us Things like stock price, CDS. So what's the price to insure on an underlying issuer's debt? What are the current market prices for said debt? Which points, how leveraged is a company? What are they doing in CP if they're doing something in CP? And then there's other tools that we use, and one of them is a fantastic new piece of technology. It's called Credit Benchmark, and what that gives you actually, as well as, of course, you have to consider the public ratings for all of these institutions, but historically, the issue with public ratings is that they can sometimes be delayed, and actually by the time there's a notification, the time has passed for you to be able to take action. The example there, again, going back to Lehman Brothers, not to pick on them, there's some very great, smart people working there, but when they defaulted, they were, single A minus publicly rated, and then the next day they were not around, they had defaulted. And so what this piece of kit that we use, Credit Benchmark, does is basically takes a consensus from credit teams of 35, 40 different banks, all of whom have risk positions on with all of those underlying entities and more in terms of their pool of contributors. It covers, the globe from, emerging market sovereigns to, corporates to other financial institutions. And here on a monthly basis, what they're looking at is probability of default within a 1 year time span. And getting that sort of information on a regular basis, leveraging off, all of those investment banks, credit departments is incredibly helpful. And I think it's one of those things where you wish it was around last time, but it's great that it is now, and it's super powerful alongside all of the traditional methods and publicly available information that is out there to form a view.
Yeah, and if we could bring up maybe the first of the slides at this point, and Henry, can you just talk us through kind of what was happening, particularly in corporate credit to begin with, as in the run up to the COVID crisis, as I guess we're going to end up calling it?
Yeah, absolutely. And I mean, look, this data only takes us really to the end of 2019, and I'll talk a bit about what's happened since then as well. But in the run up, what we've seen is a staggering growth with regard to issuance, and debt levels have doubled actually since the financial crisis, since the peak there, when we're looking at that in more real-time data. And the other thing so firstly, you've got a doubling of debt, so far more leverage in the system. Then what you've also got is actually attrition with regards to who's issuing. You've got a higher degree of companies issuing that are in the sort of triple B and then below, so very close to or through essentially what is deemed investment grade in capital markets. And what that means is essentially that you've got a large swathe of issuers where, currently, of course, the price to borrow is pretty cheap because of the amount of support that's come into the markets, but historically and ordinarily, and possibly going forward as well, were we to see a rising number of defaults and downgrades, that cost of finance goes up. And so you've got these high debt levels, lower quality of debt, and then there will be, it's fair to say, a pressure on pricing from where we are today, as unfortunately, I think we'll see more stress and, the V-shaped recovery not coming into fruition, unfortunately. And so here you can see, this graph's helpful, very clear. That dark blue line is, as we're into 2020 here, almost vertical with regard to the number of downgrades coming through. And of course, look, we need to consider the other side of the coin. What's happening with upgrades? Where are those coming? Are there parts of the economy performing well? Well, yes, they are. But clearly, from a credit perspective, they are few and far between and diminishing. So, it's a two-pronged approach. And here, corporate defaults. This from Fitch actually from July, highlighting the fact that actually in terms of level of defaults, again, we're likely to have a record year. And so, that credit question, it's important to have that in front of mind when thinking about what you do and who you do it with, frankly.
Yeah, and I guess you could be forgiven for wondering, well, why are we showing all of these corporate metrics and downgrades and defaults and what have you. But I guess the point is that this very much isn't limited to the corporate sector. And actually, if you could just bring the slides back up for me, then I'll just show one more, which is the fact that ultimately banks at the end of the day are the entities that lend to the corporate sector predominantly. So here just showing fallen angels across the board, across all industries, but going to the banking sector. You can see, and Henry, you're probably better to talk to this, but the corporate defaults have to end up somewhere. And if you add to that the pressure on bank business models in terms of net interest income, then I think it's certainly wise not to be complacent about bank credit. I don't know if, Henry, you want to just explain quickly what we're seeing here.
Yeah, sure, absolutely. So essentially, this is reflecting more current views on bank credit, essentially, and direction of travel, but not just direction of travel, but also movement from single A to triple B and then down to double B. And so what this is telling us here is that as per those 35, 40 banks that contribute, really there is credit is clearly being impaired here. And the thing to be really looking at as well and to consider is that for corporates generally, and for most of us, when you're in the triple B space, that's all fine and dandy. You're going to go into most of the portfolios out there from an investability perspective, that longer dated issuance, no problem. Being a fallen angel as a corporate isn't great. For the banks, however, there are different thresholds to consider. And that is because of the way that they would finance themselves. A lot of issuance is done in the shorter dated space in the form of CP. And they're, having a single A rating and then being able to be an A1 and, the equivalents across the rating agencies for short-term debt. There, when you fall out of that single A equivalent space into triple B, all of a sudden you lose large swathes of your funding channels. Essentially, those are able to invest and historically that would invest, come away from the table. And so moving from single A to triple B, which essentially this data is showing us, becomes more expensive for a bank. It's a sort of, it's a double effect of, well, you're looking less able to repay. You're moving into that sector where interest rates go up for you as a borrower. And funnily enough, of course, now it's harder to repay and service the debt.
It's that domino effect and the things we talked about, the relationship between solvency, liquidity, and credit are all intertwined. And Marion, maybe if we come back to you and you can talk a bit more sort of in the operating business of IOM and the ways that you manage counterparty credit across what I think you said is 200 banks, so a fairly extraordinary number. And presumably those banks are also in places that I probably can't even pronounce in lots of cases, let alone begin to evaluate their credit. So if you could talk a little bit about how you think about that and maybe also what's changed in the recent past in terms of how you mitigate that risk in the light of some of the data that Henry just talked us through.
Yeah. So indeed, at IOM, we are operating worldwide. So for us, the biggest challenge is to be able to know our counterparty first, and to be able to have tools to measure our exposure to the different market. And it's really not easy when you are starting to get out the Europe and the US banks to have a clear evaluation of your counterparty for different reasons. The first one is there is less data available. You don't necessarily have access to the information, and it's market that we don't really know very well. So with limited resources, it's started to be a very big challenge to evaluate counterparty risk outside of the well-known area that we are all operating in. So at IOM, we had to face a very basic challenge: is how to evaluate banks that doesn't have rating. because the rating is the first, it's the first ratio that we take to evaluate a bank, especially as corporate treasurer, because we have limited resources in terms of analysis. But for us, 50% of our bank doesn't have rating. So it was a big challenge to find a way to give, to assess our risk. So we had to work with financial of the bank and then convert this financial into default probability. And even doing that, we are limited to banks operating in country with rating, because there is also all the country without rating, where the banking system is very weak and it's very difficult to have information about these markets. So no, for us, I would say that the challenge is the access to the information and be able to do analysis with, I would say, the limited resources that we can have as a corporate treasurer.
And I guess just to speak specifically to that market, I know, Henry, you were putting out a piece of research, I think later today, on emerging market credit. That's not going necessarily in the greatest of directions either. We spend most of our time naturally, I guess, sat in the West focusing on what's going on in the UK and the US, and God knows there's enough interesting stuff to keep the news busy right now. But if we think a little bit further across to emerging markets, what is transpiring there from a credit perspective?
Yeah, sure. What's easy to forget is how unbelievably privileged and fortunate we all are in terms of the position of our, where we were born and those underlying jurisdictions and countries that can put through, projects that run into, the tens of billions, if not trillions. So much of the world doesn't have that luxury at their disposal. And so something like COVID comes along, and the ability to react, the ability to put in measures is so severely hampered. And so in the emerging space, we've definitely seen quite a rapid shift in terms of credit quality there. Literally from the end of March, I didn't even go back to the beginning of the year, actually. From the end of March until basically the end of September, we've seen 36 sovereign downgrades, actually, across 31 countries. Now, the record previously was in 2016, I believe, and that was 24 countries. Here we're looking at literally a 6-month time period. And so, the other thing here that might not necessarily be obvious, and same when talking about any sector and being sector specific, for example, with the banks, is that, the degree to which correlation can come in. And so diversification, takes many forms, but if it's within the same sector or within the same geography, for example, and I don't want to pick out geographies, we all know where it's, times are harder, then you can have that real contagion effect come in. But certainly, the last 6 months have not been good at all. And looking forward, there's countries that are just about hanging on to sort of BBB- ratings that, it's hard to see how that will be maintained, unfortunately. And of course, with these countries as well, a lot of foreign debt issuance where, they might be issuing in dollars, euros, sterling, or, more stable currencies that are closer to home, for example, Australian dollar. And when something like this comes about and your currency is devaluing off the back of your sovereign downgrade, the ability to refinance, even if you were to, finance at the same interest rate as prior, which of course is unrealistic, the fact that the currency is then devalued as well, again adds to that sort of domino effect that we talk of, and the fact that it's a spiraling effect that is, it's very concerning, unfortunately.
And Katherine, I guess probably a little closer to home generally for you in terms of the way that you think about and perceive credit risk. But as you look at the charts that Henry went through, as well as all of your own experiences from a day-to-day perspective, how do you think about credit risk today? What what are the things that you'd urge other people to do in terms of managing credit risk going into what looks like a period that could be a bit of a bumpy ride?
Yeah, I mean, it's interesting. What I've noticed from a lot of this conversation is how dependent we all are on the published credit ratings of the major credit rating agencies. And, going back to 2008, it was, I think regulators tried to step in and find a different way of doing things, and haven't been particularly successful. And lots of structural reasons why those ratings are so useful. But I think, we've also pointed out the shortfalls with those credit ratings, and, that rating agencies are not particularly fast to move. And, those of us who've looked at credit ratings from both sides of the perspective on it, and know that it's, the process isn't perfect. And, so I think a lot of it comes down to what are the other indicators that you can use, and what are the other markers that are out there, things like CDS prices, things like stock prices. Just, I think, understanding a bit of fundamentals, and following what's going on in the news, and knowing what's happening to the banks that you're dealing with, and whether there are particular issues in particular countries or particular banks. Or I think there's no easy answer to this, and we all have to kind of use all the skills and all the intelligence that we can get hold of to really think about what the counterparty risk is, and the way that it will affect us, and what happens in cases of default. And it's clearly an issue that's going to be very top of mind as we move through this crisis, and various levels of government support get withdrawn, and we see which businesses can survive in the longer term. All of these techniques, I think, are going to be relevant to us for quite a long time in the future.
Yeah, and I think there's a few things on. The first is acknowledging that credit risk is an issue, which I think probably everybody around this table agrees that it is, virtual table at least. The second is working out how to monitor and analyze that credit risk, and we've talked a bit about that. And then the third is sort of operationally, how do I mitigate that credit risk? What do I actually do once I've sort of identified it, once I've figured out that this, how to monitor it? What's the actual end point of that? Marion, I know that you've, in dealing with your operational side of your business, you mentioned to me previously that you've taken steps to try and make sure that cash sits in places for shorter periods of time, and there are other ways in which you can operationally mitigate credit risk. Could you just talk quickly about that?
Yeah, so as we are not really sure of the default probability, we are mainly focusing on the expected loss of our different exposure. So indeed, we really try to limit the expected loss. So with all our mission worldwide, what we are trying to do in practice is just to send less funds, but more often. It's a very basic way to mitigate the counterparty risk, but at least it's something that we can put in place very easily, and that we can monitor for sure. So we make sure that we send funds only when their bank balance are very low and they really need the money. So this is for the day-to-day operation, the quick actions that we put in place at the beginning of the COVID crisis. So focusing on the expected loss and how to reduce it.
Thank you. So I think that unfortunately we are almost out of time. I know I could definitely talk about this for a lot longer, and Henry and I will, I'm sure, continue to do so and drag anybody who's willing to listen in over the course of the next months and years. But I guess final takeaway from me is that there are clearly movements afoot in the credit market. I think, unfortunately, it's important for people to understand that the crisis is very much not over, and from a credit perspective, it may indeed only just be beginning. So would urge people to pay attention to credit, would also urge people to, as everybody's mentioned, look at what tools they can have to evaluate that counterparty credit, and then of course to try and put in place measures in order to mitigate that credit, whether that be pure operational measures, whether that be collateralization, whether that be using a platform like ours in order to genuinely diversify and get exposure to sectors that you can't generally. But with that, I guess I will wrap up. Thank all of my panelists very much indeed for their time. So thanks to Katherine, thanks to Marion, and thanks to Henry, and hope that it was a useful discussion for folks.